When most people walk into a Courtyard, Hyatt Place, or Moxie, they see a nice hotel. But did you know these assets actually belong to a niche hospitality segment now emerging as its own focused asset class? Why? Because their operating model and investment profile look different than traditional full-service hospitality properties, catering to more modern traveler preferences while delivering resilient returns. This segment is called select service. So, what exactly is select service? Select service hotels strike a balance between full service and budget accommodations. They have a smaller footprint, fewer amenities, and reduced staffing needs. With limited meeting space and minimal food and beverage offerings, they focus primarily on room revenue, the biggest driver of hotel profitability. For comparison, full-service hotels average 310 rooms, typically require a 3-meal restaurant, and often offer 5,000 plus square feet of meeting space. These amenities require more staff and maintenance costs. In contrast, select service hotels average just 125 rooms and operate with 10 to 20 employees. That's half the workforce on average of full-service hotels. Now let's look at the customer base. Full-service hotels depend on corporate meetings, conventions, and business travel. Select service, on the other hand, succeeds at lower price points, attracting a broader, more resilient consumer base like construction teams, medical professionals, government workers, and long-term business travelers, guests who prioritize quality, convenience, and affordability over ballrooms and multiple restaurants. This broad mix of guests keeps select service hotels busier, with occupancy rates averaging about 75% in 2024 compared to under 69% for full-service hotels. More heads in beds means more stable revenue no matter the market conditions. During the pandemic, when full-service demand plummeted, select service held steady. Between 2003 and 2019, its profit margins averaged 13% higher than full service, soaring to 26% higher in 2020. With leaner expenses, fewer employees, and longer stay bookings, these properties generate strong and consistent cash flow. But let's take it a step further, because there is an even more efficient subset of select service: extended stay hotels. These kinds of properties, like Marriott's Residence Inn and Homewood Suites by Hilton, cater to guests staying weeks or even months at a time. They serve long-term business travelers, medical patients, traveling nurses, relocations, construction crews, and displaced homeowners. With kitchenettes, larger rooms, and reduced housekeeping frequency, extended stay models cut costs while maintaining steady demand. And while select service and extended stay sectors have long outperformed other hospitality sectors, there's fascinating data that reveals highly compelling opportunities for strategic investors in 2025. Unlike other real estate asset classes experiencing oversupply, new development in the hospitality sector has slowed dramatically. Hotel supply growth in 2023 was just 0.3%, well below the long-term average of 1.7%. The bottom line, select service and extended stay hotels consistently deliver superior yields when compared to other commercial real estate sectors. They generate strong annual income and have shown relatively low yield volatility over the past 16 years. For investors seeking high-performing, low-volatility hospitality assets, select service and extended stay are clear winners. And with PEG's deep expertise and full control through our vertically integrated model, we know exactly how to maximize value in this lucrative segment.